What's up, y'all? What's up, y'all? Starting soon. Get ready, couple of minutes. Today we flex. What's up, Diego? What's up, Travis? Final preparations. Thank you for joining, as always. Yes, sure thing, Diego. Take your time. What's up? What's up, everyone? Spotlighting myself. Diego is coming soon. What's up, Travis? What's up, Travis? See you, brother. So, I will just give some quick introduction. I know Diego is coming soon, hopefully. Don't know if anyone else will join. A couple of guys asked me whenever I did my stories, basically, how can I join? I just said them, like immediately, Patreon member and stuff. So, but I don't think anyone will join. So, typical introduction. We're giving some time to Diego. So, how was battery day? Have you seen battery day yesterday? Your microphone is muted.
Yeah, the long-term investors, I heard, were happy, but the short-termers were not.
I don't know, like what, minus 10% today in one day?
That's a lot.
Something like, I don't know what's that right now. I just checked it. It was minus 10. Let's
Yeah.
see really quick. I guess like kind of similar, but it's Tesla. Like give it a couple of days, it's gonna be back and even higher than this.
Yeah, that's right. Yeah, I have it in my ARC ETF, and it's down almost 5% today.
That's Tesla. That's Tesla. Yeah. Companies that are so much overvalued, like as soon as there is at least one bad news, and it's not even necessarily supposed to be like huge bad news, something small, something bad, that's it, people are panicking because they already know that the company is so much overvalued, and they're literally like so scared anything can happen because they already know that they already made huge profits. And that's it. Something bad happens, even small thing, that's it. You see the result. So you can basically imagine what will happen if something actually bad happens.
Oh, for sure.
That's
a real scandal.
Yes, something like this. And yesterday I just watched like the very beginning of this stuff. Whenever there was like shareholders meeting and there were like questions to discuss, things to approve or decline. So there was like one guy talking about that Tesla is using like in this in their like whatever they're mining. I don't know this whatever it's called, like carbon, whatever, I have no idea. So they're mining stuff and using child labor. And the guy said that there were like, he saw that there were like kids missing limbs because of mining stuff.
Oh
So,
no.
but Tesla, they very strategically made this thing like go away. They heard this guy, the guy was talking like for 3 minutes, and then like the guy who was doing the presentation, he's like this and this and that, and like switch the topic, basically.
Pivot real quick.
Yeah, so yes, if it's true, if it's going to be confirmed or no, this could be one of such things that will bring Tesla back to normal. But I don't know, like I guess just Tesla has the same amount of haters as the same amount of lovers. So
Yeah.
So you got something you want to say something before we begin? Somehow.
No, I'm ready to learn, man. Let's do this.
Yeah, because we have like 45 minutes. I guess Diego is either back or he will just see the beginning and the recording. Still, I have like a couple of minutes introduction, topics and stuff. So yeah, where is my presentation? It's right here. Let me close this. Let me open that. Your slide, here you go. And the stuff, it's going to be exactly how we were doing basically in the past. I go through the slide, and then after the slide, I'm going to be answering the questions and admitting people if there are more people joining, so I can focus properly, basically. And share screen, where is this? Number 1, photos, okay, here, share. Okay, so cleaner, okay, supposed to be full screen, so far, so good. Okay, today, 9:23, 23 is the best day, best number in the world, obviously, so best presentation in the world. They are talking about fundamental analysis, the very beginning of fundamental analysis. And today we talk about the first things to look at while you receive the company. There is a company that you want to invest in, and where would you begin, basically? This is the first things to look at when you begin analyzing a company. Okay, basically don't want to stay for long in this slide. There's nothing to stay. And here are the topics like you already saw in the Instagram group that I sent. So and I'm not saying that those topics in particular order, that for example, like yes, revenues are the most important in my opinion. But for example, like dividends, you see number 5 is dividends. Not all the companies are paying dividends. So what I'm trying to say here, that those topics, subcategories, categories are not in the order of importance, even though I would suggest you treating first 2, which is revenues, EPS, net income, cash, and debt and liabilities as the most important ones. These first 2, that's why I put them at the very beginning. These 2 are always the most important ones. And the rest is basically important still, but not as much. Okay, so, and the first one, let's see if Diego is back. Let's see if anyone else is asking to be included. If there's any questions, I don't see any. Okay, so the first one is revenues, EPS, which stands for earnings per share, net income, and cash. Revenues, EPS, and net income can be found on the income statement. Some companies call it profit and loss, PL statement, which is profit loss statements, but usually it's just income statement, simple as that. And cash can be found on the balance sheet. Revenues is the top line. Revenues is basically, it is if the company is selling physical goods, if the company is selling services, whatever money company makes, whatever, without any deductions, all of this, every single cent of this money is recorded in revenues. So income statement is basically like a ladder. You start at the very top of the ladder, and this is your revenues. And every step you make downstairs, this is when you give money to someone else. So you start with revenues at the very top. You make a step down, you pay salary, for example. You make another step down, you pay to your suppliers. You make another step down, you pay taxes, and so on and so on and so on, until in the very end, you reach bottom line. Until in the very end, you reach the last bottom step, which is net income, or if you didn't get any money, it's net loss. And that's why it's called bottom line, basically. So you start at the very beginning with revenues, every single cent that you made selling your stuff or services. And you end up in the very bottom, whatever money is left after you pay everyone else, like I said, suppliers, your employees and stuff like this, taxes, whatever is left, it's bottom line, it's net income. And in my opinion, the most important, or at least one of the most important areas to look at is the revenues, is the basically whatever company made. For example, you heard about this Nikola stuff, and they made like literally $36,000 in revenues. That's everything that they sold in the whole quarter. And this was basically the solar panels for this Trevor Milton guy. Like literally this like ridiculous revenue of the whole multi-billion corporation is $36,000. Maybe it will be acceptable if it will be like net income, but it is revenues, and they made just $36,000, not even $1,000. Ridiculous, like basically, it's like so obvious scam and stuff like this. And this is very important to see if the company is increasing or decreasing sales. And sales is basically the synonym of revenues. Sales and revenues are the same basically, because some income statements, they use revenues, as they use word revenues. Some companies, they use word sales, but these are synonyms. Revenues equal sales, sales equal revenues. And so basically, like I said, if you see that this area increases, it means that the company just sells more of its products or services. If it's decreasing, it sells less, simple as that. And this is very good to see, because to see if the company is expanding, long story short. And EPS, or earnings per share, this is found, like I said, revenues, EPS, net income can be found on income statement. And EPS is the earnings, which is net income or loss, so bottom line basically, divided by shares number of shares. Number of shares can be found in the balance sheet, on the balance sheet, for example, or you can just Google, or you can go to SEC, Edgar database, or even on Yahoo Finance. Like, this is not a secret. Public company must disclose everything, not a secret. So you take bottom line, whatever money is left, and divided by shares, number of shares. And that's why sometimes you can see that EPS is a negative number. So for example, like your revenues is 1 million, and you have, I don't know, for example, like let's say 100 shares to make it super simple. And your revenues are 1 million, you pay suppliers, you pay your employees, you pay taxes, and you have just left, I don't know, $600. This $600 is net income. You take 600 divided by number of shares, which is 100. That's it. Your EPS is $6 per share. Simple as that. Or if you, after you paid all employees, suppliers, and taxes, you do not have money at all, and you paid literally out of your own pocket, then you have net loss. For example, minus $600. Then your EPS is minus 600 divided by 100, minus $6. And long story short, this is important to see because basically to see if the company makes money. If like investors, they buy shares, like they buy 1, 5, 10, 100 shares, and they want to see if those shares are bringing them money or they make them lose their money, long story short. So, and this EPS is a little bit less important than revenues, but once again, every single investor has his own favorite and most important areas. For me personally, revenues are the most important, less important is EPS. So then comes net income, which is for me less important, but still important. And once again, this is the bottom line of income statement, which can be either net income or net loss. So why it's not that important for me? If I see that the revenues are increasing, but for example, like people assume, let's say, so that if revenues are increasing, constantly increasing, net income will be also constantly increasing. Like for example, you have $1,000 in revenues, 500 in salaries, 300 for suppliers, 100 for the taxes. So 5,3, I mean 1, so 1,000 minus 900, your net income is 100. But if the next period you made 1,100 in revenues and your salaries are the same, suppliers are the same, and taxes are the same, long story short, people think that your net income will be $100 more because revenues increased by 100, so income will be also 100 more. Partially they are correct, but it's not always the case, because if the company is doing mergers and acquisitions, if the company decides to increase dividends, if the company decides to buy some new equipment, new factory, build new factory, if the company has a new massive project coming, research and development, this will not affect revenues, but this will affect net income. For example, and like when you do not build factories every single quarter, building new factory can be happening like once in 5 years, once in 10 years. So that's what I'm saying. You might see revenues being increasing stable every single quarter, but then one quarter, suddenly net income is negative. Like, so you need to see, maybe company did some big project, maybe company bought something, maybe company acquired another company, and that's it. So for this reason, you do not need to freak out when net income is negative or when EPS are negative, but you need to freak out when those things are negative and revenues are decreasing. And obviously revenues cannot be negative because this is, like I said, this is the money that you received for selling your products or services. You cannot sell negative amounts of services. So that's it. The lowest revenues can be is zero. It can never be negative. At least I haven't seen negative revenues. Another thing very important is cash reserves. And this can be found on the balance sheet under current assets. And this is very important during bad times, whenever like either market is collapsing as a whole or the company is experiencing troubles. Why cash is important? It is because cash allows companies to survive longer. Whenever there are no sales, whenever there are no revenues, whenever the suppliers are leaving the company, whenever customers are not using services anymore, how much cash you have left, it determines how long you can survive. It's literally like I don't know, like it's your emergency fund, basically. If we make it to personal funds, it's your emergency fund. Whenever you lose your job, whatever you have cash in your emergency fund, this is how long you can survive. The same with the companies. And obviously you want to see lots of cash during bad times. Companies, and I see that a lot of companies, yes, whenever this pandemic started, lots of companies increased their cash reserves. Like I said, this is a good sign because no one knows when it's going to be over. And a lot of cash means that you can survive longer. But whenever company is not in a bad time, whenever everything is good, basically, whenever market is in normal condition, it is not important for cash to be for a company to have a lot of cash. Why so? Because cash, whenever company is doing good, it's basically lying idle. It's doing nothing. There are obviously way better uses for the money. So instead of just keeping them on the checking account or savings account, company might use this cash to do a project, to do something else, to buy, to do mergers, acquisitions, all this kind of stuff. Yes. So whenever company is in good condition, it is better to see cash being low, but not extremely low. But whenever it's a bad condition for the company, it's good to see cash reserves increasing. And the last thing about all these things, revenue, CPS, net income, and cash, it is best to look at all of these things within 5 years period, or at least by quarter, every quarter. Basically to see if if you just see revenue at this very moment, at this very time, it just gives you nothing. Like, for example, you see revenues is 1,000, like, okay, I guess it's good, but you need to see what's the revenues comparing to the previous year, previous quarter. Like 1,000, it gives you nothing. What if last period you had like 10,000 in revenues? Now you see that your revenues became 10 times smaller. Or the same, like last quarter, your revenues were like 200, now it's 1,000. Now you see that now it's 5 times higher. So you need to see basically you need to look in the past. You need to compare it within 5 years. It's not extremely mandatory to look at 5 years, but this is more than enough to look at the 5 years period. I personally look at least, if I look by quarter, I look for 1 year and like each quarter of the year. So basically I look at the 4 previous quarters. Or if I'm comparing annual financials, then I look at least, I would say 2, 3, 4 years in the past. So 5 years, it's like I said, it's more than enough. I guess that's it about this slide. Let's see if there are any questions or if there are any people joining. Yes, I see 2 questions. Diego is back. Welcome back home.
Hey, I do have a
Yeah, you have a question? No?
Yeah, I do.
Yes.
So when we're looking at these revenues,
You again muted yours. Okay, again muted.
All right, cool. So when we're looking at the revenues and then the EPS, would you be able to find that info for an ETF, or what would do ETFs publish revenue for all the basket holdings, or is that just apply to single companies?
Okay, so a very good question. And usually I would say maybe no. Usually, whenever you go to the websites, because I'm not personally investing in ETFs, and you do not need to basically, this is too much information for you. Let me put myself. So this is too much information for you, because for example, if you're investing in total market ETF, or at least S&P 500 ETF, like fund managers, in order for you to provide this information, they will literally need to combine thousands of companies' financial reports into one. And this will literally be it will not give you that much sense, because if 100 companies are increasing, but 50 companies are decreasing, this increase in this 100 and decrease in 50, they may net each other out. So basically you will not see any difference at all. Whatever they do in return for you, because yes, I was looking at ETFs like Vanguard websites, whatever they give you in return as a part of analytics, let's say so, they usually give you the expense ratios, and they give you the performance of the ETF comparing to the market or S&P 500. And I would say this is way more important to look at those things, because like I said, like there are thousands of companies in ETF, like you do not need to know, like your revenues will be like in trillions. So so long story short, like this. Okay, hopefully that answers your question, and I guess we can go further then, yes? Okay, so let's go next slide. Where is the picture? Photos, okay. Share, full screen. Debt and liabilities is the next important area to look at while starting your fundamental analysis. This is on the right side of the balance sheet. Balance sheet is one of three main financial statements. On the left side, you have assets. On the right side, you have liabilities on top. And on the right side bottom, you have shareholders' equity. And so top right corner, it is balance of the balance sheet, it is total liabilities basically, okay? So it is very important to look at those things during bad times. It is always important to look at them, but it is very important to look at debt and liabilities during bad times. And once again, either bad times of the market as a whole or any particular company. Because once again, if you see that the company is doing, like market crisis started, yes? I don't know, like pandemic started, or like there's financial crisis over the world. So companies are all in distress right now, shareholders pulling their money away from the companies. So basically companies are starting their survival mode. You do not want to see during bad times companies with huge debts and liabilities, especially huge current liabilities. Current liabilities, long story short, total liabilities, they can be divided into subcategories: current liabilities and long-term liabilities. Current liabilities are the ones that need to be covered, that need to be paid out within 1 year. And this is, for example, such things as like salaries or suppliers, like payments to suppliers. So basically, you cannot delay paying salary for more than 1 year. You need to pay it like every 2 weeks. So that's why it is current liability. So, and obviously, like I said, it is bad to see companies with huge liabilities, and it's even worse to see companies with huge current liabilities during bad times. It means that companies have big liabilities, and the situation on the market is far from being perfect. And at the same time, it is also very good to see liabilities in relationship with the current assets, and especially cash reserves. So for example, if you see that something bad is going on with the company, either market is collapsing or company is experiencing some problems, you see that the current liabilities are pretty high and the company has very little cash reserves. It means that the company will experience financial problems unless something changes. And if the company does not increase its cash reserves, and that's what I said like 5-10 minutes ago, I saw that decent amount of companies, they actually increased their cash reserves when this pandemic started, which is a good sign, obviously. But if you don't see that the cash reserves are increasing, but current liabilities are same high or even increasing, like that's it. Company will just have no money to pay salaries, basically. Company will just not have money to pay to its suppliers. And in order for the companies to stay active in business, they will need to either sell their equipment, to fire people, basically. That's what we see what's going on. So they can increase cash reserves. The worst thing is when the company starts selling their money makers. For example, factories or equipment, or like Carnival Cruise Lines was selling cruise ships recently. Like this is their money makers. Yes, In the short-term perspective, this will definitely help them to survive longer. But okay, pandemic is over, and that's it. Now they have like twice less fleet. The fleet size is twice less. So yes, they survived the pandemic, but now they will be making twice less money, for example. Yes. So this is the last case scenario for a company to do, is to sell its money makers, like I said, factories, equipment, machinery, or like I said, cruise ships or anything like this. And it is okay to see liabilities increase. So this might sound controversial with what I just said, but it is okay to see liabilities increase over long term. And I'm mostly talking about like total liabilities, not already current, but total liabilities. Because if the company is increasing its size, if the company is expanding, if the company opening new factories, if the company hires new people, all of this will increase liabilities. More people, more salaries to pay. New factory, basically you need to construct factory, you need to rent the land, buy the land, you need to buy all new equipment or rent all this equipment. If the company is expanding, liabilities will increase. So for this reason, if you see that liabilities are increasing, but at the same time revenues are increasing as well, it means that this is a healthy expansion. That the company, like I said, hires new people, opens new factories, opens new stores, all this kind of stuff. In this case, it's good because companies need to expand. You cannot always be the same size. Like you can be, but like it's not good. You need to expand basically. And once again, it's also best to look at debt and liabilities over a period of time, just like at the previous example. Either look at the past year, but look at all the previous quarters, like look at the previous 4 quarters. Or if you're comparing annual financial statements, look at like 2, 3, 4, or up to 5 years in the past. And once again, what I was saying almost in the beginning of this, that it's good to see that liabilities are increasing. But if the liabilities are increasing, it is good that if they will be increasing at a stable rate. For this reason, you need to basically take total assets and divide by total liabilities. And once again, it's good when it's stable. It means that the expansion of the company is healthy. Like basically, like I said, if you see that the company buys new factories, hires new people, it increases liabilities and it's supposed to increase assets proportionally. So if you take assets, which is like 1,000, liabilities is like 400, like 200, let's say so. So total assets divided by total liabilities is 5. And if you calculate these total assets divided by total liabilities for every year for the last 5 years, and this number is always more or less 5, one time it's 4.8, then it's 5.1, then it's 5, then it's 4.9. It means the company is expanding at the healthy rate. Okay, so that's that. Let's see if there are more people joining or more questions. Otherwise, I'll continue. I think I have like 15 minutes left. Good. Well, so far so good. Okay, don't see any more questions. I guess we can go then. Continuing. The next one is inventory and sales. Mainly in this topic, in this section, I'll be talking about inventory. And inventory is the part of current assets. Current assets, once again, can be found on the balance sheet on the left side. Once again, left side is assets, right side is liabilities, and shareholders' equity. And under total assets, there is subcategory of current assets, and under current assets, there is subcategory of inventory. And basically, inventory is exactly what you would imagine it to be. This is like inventory, nothing else to say. This like if the company sells, I don't know, cars, Tesla, inventory is the Tesla cars. If the company sells coffee, it's coffee. It's whatever you're selling. And this is obviously, as you can see, important for the companies that sell physical goods. Because if the company provides services, like internet companies, phone companies, like yes, they might have inventories, but main income for them comes from the services, providing services. They barely sell any physical goods, or they might not sell physical goods at all. So for this reason, this thing is very important to look if the company is selling something physical. And it is even more important for grocery stores, which is basically like Walmart, Target, whatever, Kroger, yes, if I'm not mistaken, yes, I think it's grocery store, yes. This is very important for these companies especially. Why? Because Walmart sells food, for example, okay? Food expires, obviously. So you don't want to see inventory for grocery stores increasing. So basically, if you see that inventory is increasing, if you take any company, let's even go away from Walmart right now. If you just take inventory for any company that sells physical goods at this very moment. If you see that inventory is increasing, it means that the company has troubles selling it. It produces the same amounts or even less or more, but it has trouble selling it. So warehouse starts having all these boxes like everywhere, like inventory starts piling in the warehouse. Company has trouble selling it. And if the company has trouble selling its inventory and this company sells food which expires, obviously as soon as the food expired, like if you are a good company, you'll just need to throw it, which basically means you didn't receive any revenues from this. You bought food from the supplier, you was not able to sell it, that's it. Your revenue on this was zero. You literally just throw away your inventory. So for this reason, inventory is extremely important for the companies that sell, like I said, things that expire, or for the things that produce like every single year, like there's a new model of something. For example, iPhone. You see that inventories of Apple are increasing, like increasing, constantly increasing, and then there's new phone coming, iPhone 12. So obviously, whenever there's iPhone 12, way more people will be buying iPhone 12, and no one will buy like previous models. And if you see that inventory is pretty high for Apple, it means that that's it, like it's dead weight for them. They cannot get rid of this. There is very, very, very little demand for the previous models. And for this reason, it's very good to see inventory divided by current assets. And I think, yes, I already told that inventory is a part of current assets. So obviously inventory will always be less than current assets because inventory is a part of current assets. And once again, it is good to see that inventory is always more or less the same ratio, is the same amount, the same proportion of current assets. It means that the company produces exactly what it sells, basically. If you see that inventory is like 10% of current assets and it's the same, every single quarter is the same, it means that the company produces and sells almost all of its inventory, like it still has like 10% on the unsold, but more or less it means that everything that they produce is everything is sold. Perfect to see when this is stable. But if the revenues are increasing, it is better for you to go to this income statement and see that the sales are increasing as well. Like inventories increase, for example, can be noticed for cyclical companies. I don't know, like companies that sell Christmas trees. Obviously, no one buys Christmas trees or Christmas decorations in the middle of the summer. Everyone buys this like in late fall or in the winter and stuff like this, yes? So those companies, they might see that inventories will be increasing for such companies. But obviously, you will need to see that the revenues and sales will increase as well. It means that the company produced extra goods, and it means that they're selling more than usual. But whenever you see inventories increasing, but sales are the same or even decreasing, this is very bad. Basically, company starts producing more things, but they are selling less than they were selling before. It means that the warehouse gets stuck, piled up even fast at a faster rate than before. Okay, let's see if there are any questions so far. If there are, okay, unfortunately, yes. Oh my God, 6 minutes left, 7 minutes left. Okay, yes, I need to do something about this. Okay, yes, let's see. Maybe we'll need to restart again or something. I think I have at least 2-3 more, let's see. Okay, retained earnings. Retained earnings is the next one. Retained earnings can be found under shareholders' equity on the balance sheet, on the bottom right, basically, okay? And these are the money that's left after all the expenses, including dividends, are paid out. So basically, you have like salaries, all this like suppliers, taxes, and like dividends as well. That's why I included them because like as soon as everything is paid out, whatever is left within the company, it is retained earnings. So basically, net income is like retained earnings, but net income is on the income statement, but retained earnings, which is supposedly the same number, it's on the balance sheet. Same number on 2 different statements. And this is increasing the retained earnings is a sign that the company might take some future big projects. Once again, retained earnings, these are money that lying idly without anything. Basically, it's almost the same as cash. And if you see that retained earnings are increasing, you need to hope that the company is planning some future big projects, because like I said in the cash section, if there's a lot of cash lying around for the company, but the company is not doing anything with this cash, it's wasted opportunity. The company might do something with this cash, but instead just lets it sit on the check-ins account. So not good. And if you see that retained earnings are increasing, it's a sign that maybe company in the future will take some big projects, do mergers and acquisitions. Maybe they'll do research and development. So if you see retained earnings being increasing over the time, but you see in the news that the company is not planning to do anything, it might be a sign of the poor management, that the management that just doesn't know what to do with all this extra money. Okay, dividends, my favorite. 4.5 minutes left. Let's see. No questions? No questions? No people joining? Okay, let's go about dividends then. Favorite stuff for me. Obviously, it's only relatable to companies that pay dividends. If the company is not paying dividends, like there's nothing to analyze. It's going to be zero, like nothing. And if the company pays good dividends for a long time, it's a good sign that the company is good with cash. It literally means that like dividend, what is dividend? It means that the company has so much money and they just literally say, thank you for investing in us, here's some money for you. It's literally just money for these purposes, like, and that's it. It's good when investors reinvest dividends back, but like this is literally it. The company has no guarantees that the investors will reinvest these dividends back. So technically, whenever they're paying dividends, they're saying buy this money. But if you see that, like I said, if the company pays dividends for a long time, and especially when they're increasing dividends, it's a good sign. It means that the company always has this extra money that they can just literally just throw away. And for this reason, so-called term as dividend aristocrat was introduced. You might have heard about this, the one that company that pays and increases dividends for 25 consecutive years. And this title, as you can already see, very hard to achieve, and it's very easy to lose. And obviously, if the company is a dividend aristocrat, and at this very moment, if I'm not mistaken, there are just 65 only dividend aristocrats among US companies. This title alone attracts a lot of investors, just because investors know, okay, this company been paying dividends for 25 plus years, it must be a good company, and that's it. This title alone already is a very good sign for a company to at least research it. I'm not saying that always invest in dividend aristocrats. At least it's a very good company to research for you personally. And never chase high dividend yields, because dividend yield is basically dividend divided by net income. And if your dividend yield is, no, dividend yield is dividend divided by share price. Now I'm confused for some reason. I guess it's because of the time limits, and now I'm, okay. So yeah, dividend yield is the dividend amount divided by share price. Yes, dividend per share divided by share price. And if dividend is 5, but price of the share is $50, 5 divided by 50, it's like what, 10%. Dividend yield is 10%, pretty high. But if it's dividend is 5, but the share price is 100, then it's like 5 divided by 100, it's like 5% basically, yes, better. So if the dividend yield is high, it means that the share price got very, very low. And if the share price goes very, very, very low, it means something bad happened. Long story short. Okay, I think I have, yes, 2 minutes left. And last one, shares outstanding. If you have any questions, ask them right now in the chat. So I will, if I see any questions, maybe then I'll need to restart. Otherwise, we'll just need to finish in a couple of minutes already. Unfortunately, again, no room for questions. But like I said, if you have them, ask them. I'll restart and I'll answer the questions in the calm environment. The last one is shares outstanding, can be found on the balance sheet in the shareholders equity section. Shares outstanding is the shares on the market. That's it, like simple as that. And treasury stock, it's shares that are not on the market. For example, company issued 1,000 shares, but it only put 800 of them on the market. So 800 are shares that are traded among other investors. These are shares outstanding. But from this 1,000 that they issued, 800 they released on the market, and 200 they just keep in the company still. They did not release them. These are treasury stock, shares that are not on the market. And obviously you want to see shares outstanding decreasing, so which means that there are less shares on the market. And if there are less shares on the market, it means that there was a buyback. And buyback, when the company buys back its own shares, which is always a good sign, which is 99% is a good sign. It means that company has good perspective. It believes in its own company. It has extra money to buy its shares back. So that's it. And it also creates less supply of shares. So previously you had 800 shares, and now you have just 600 shares on the market. So less shares available for people to buy and to trade them. Let's see. Less than 1 minute says, okay, and releasing additional shares dilutes them.